this isn't a game of us. This is a game of me. And where do I make money? Where do I prevail? And so that was the big turning moment in year 2.5, was identifying where my weaknesses and where my strengths were and putting all my focus into my strengths. I don't care about losing. What I care about is losing unnecessarily or undisciplined losses. Those are the ones that I end up staring at the wall, staring into a space, just like really upset with myself because, I know better. If there's a stock gapping up 100%, just to be frank, Mike Huddie is getting short at some point, I promise you. Right now, that 60 to 70% of them will close below their opening price. And why? Because a lot of them are dilutive piece of crap companies that need to stay alive. So once I had that part of the equation, it was all about, okay, now where do I find good risk reward? How do I position myself so that by the end of the day, I'm here and I haven't gotten stopped out? That's where the sauce is. I struggled after the OTCs went away in 2022 and 2023. Those were tough years for me. Barely even profitable, right? Which is crazy to think because I had a 5 or 6 year spree of profitable every year, making good money, making exceptional money, and then all of a sudden it hit a brick wall. And for a moment I was nervous. I was like, am I gonna ever find it again? Am I gonna be able to get it back?
Is this travel trading lifestyle as good as you first saw it 9 years ago?
I think it's better.
He was once a high school student with a 2.0 GPA, a not-so-great student who skipped classes all the time, and a door-to-door salesman at one point. If you were to tell me that he was going to become a millionaire trader through penny stocks and small cap trading, I wouldn't have believed you. But Mike Hudson, aka Huddie, he really did it. Huddie was once a trader who focused entirely on OTC penny stocks with his discretionary trading approach. But through tons of trials and tribulations, nowadays he's a systematic trader with very strict criteria, rules, and executions, all backed by data. The key to Huddie's story and how he's been able to achieve longevity and consistency in trading over the last 9 years is adapt or perish. In our conversation with Huddie today, you're going to learn how Huddie turned red to green with his P&L through backtesting and data tracking, how he was able to turn his discretionary trading approach to more systematic over the years, and Huddie's process of collecting data, statistics, and tracking all of those things and adapting his strategies in various market conditions. Make sure to drop a like down below the video. It really helps to support the Humble Traders podcast. And now let's get ready for an insightful conversation with Huddie. Welcome, Huddie. Welcome to the Humble Traders podcast.
Hey, Shay. Thanks for having me.
I've seen you on a lot of podcasts on YouTube and Instagram, so it's a pleasure to finally see you and meet you in person. I'm sure we can talk a lot about traveling, trading, and your strategies with our viewers today. On a high level, how would you describe what kind of trader are you and what kind of strategies are you predominantly focusing on?
So what kind of trader am I? I'm an intraday trader. Generally, I'm trying to day trade. Generally, I'm trying to short sell. And generally, I'm trying to short sell small cap. One of the main things I like to do is short sell small stocks that gap up really big that are, generally piece of crumb stocks. So a lot of the times what you're going to see in small cap are these stocks that will put out some kind of fake PR or some kind of fluffed up PR that gets their stock up, 100, 200, 300% in the pre-market before the market even opens. And a lot of the time, what I've noticed in this 9-year journey that I've had trading stocks is that the bloodline for small cap is financings, it's dilution. These companies are so bad that they can't go to the bank and ask for money. The bank's not going to give it to them. They have to finance their stock. And the only way to finance their stock is to get the stock up. And a lot of the times it's artificial. It's a bogus PR that gets their stock up in the first place. And again, what's the end goal for this is to show that stock has appreciated and get some kind of financing or enact the financing that they already have there. So it kind of feels to me like an infinitesimal edge because as long as these companies need money and can only get money through diluting their stock, there's always going to be some type of downward pressure. Maybe not on every single one that kind of goes through this rigmarole, but in a majority of them, this does exist.
I see. So you did mention you're predominantly short selling and you've been doing this for 9 years, right? Mm-hmm. How did you find out about trading in the first place?
Okay, so this was back in 2015. I was in San Francisco. I was in college.
Okay.
And I was in a business ethics class. And my friend had invited me to an app called Robinhood. Have you heard of it?
Yes,
Okay,
I
so
might have.
Okay,
I
so
might have.
back then it was in the beta. You needed an invitation to get in, and he had told me it's no commissions. You can just buy a stock, and all right, that sounded really interesting to me. I've always been curious, but no formal training or anything like that. And so I put $20 into that account. I bought a few stocks that I researched in that business ethics class, and since it was only $20, what could I buy? I couldn't buy Apple. I couldn't buy these big companies. I had to find stocks that were $20. And I also wanted to diversify. So I actually found stocks that were $5 and $4 and $3. And I didn't know what I was doing. I had no idea. I was just kind of picking a few random stocks. And this is what led me to where I live today, which is small cap. Predominantly, I'm trading companies that have less than a 300 mil market cap.
Okay.
And the reason I found this area was because of that initial account that was just small.
Yeah.
And that led me to Google. That led me to a guy named Tim Sykes, which
Yes.
I think most people know about in the stock trading world, the day trading world, but especially in the cheaper stocks, the penny stocks, the OTCs, all that good stuff. So it was kind of this natural evolution that led me to him, and signed up for his course, did his course for about 2.5 years, found some grounding, some foundational skills from him, and then started to experience consistency from there.
Yeah, it's interesting. If it weren't for all the Lamborghini ads, a lot of us wouldn't be here today.
Yeah, well, it wasn't even the Lamborghini ad that really spoke to me. It was exactly how we started this, which was he said, travel and trade from anywhere in the world, live your own life, don't have a boss, get rid of all that. And I love traveling. I love making money. I love finding opportunity, and I love jogging that creative side of my brain. So the Lamborghinis never impressed me. The Ferraris, I don't care. I don't care about necessarily that stuff. But I do care about independence and freedom. And so that message really spoke to me, and that's what I wanted. That's what I wanted to ascertain.
Yeah, we should talk about all the travel and trading stuff in a little bit more too later on, because I do wanna talk about, since you are living and breathing through that lifestyle, I do want you to see if you can share with our viewers what it's really like. So you started out 9 years ago with penny stocks. Were you instantly successful right away, or how long did it take for you to find some consistency?
So I actually had probably one of the longer routes to consistency. It took me 2.5 years to stop going one step forward, 1.5 steps back. Okay. I'd have a good trade, and then I would eradicate that trade and take another half step backwards. And then I'd progress, and then so it was kind of that for a really long time, 2.5 years. And then I started to focus on kind of one pattern at a time. Okay. The pattern that wasn't causing me to have the big losses. So there was a point in year 2 that I looked at my overall profits. I've always been a big tracker of trades type of guy. And I was up 20 grand on, I remember this like it was yesterday, so long ago now. I was up 20 grand on my short selling, and I was down 2,000 on my longs. So it was a pretty easy equation. Stop longing, because I haven't made money there for 2.5 years, and focus on the short selling. And so then I went through all my patterns of, where am I most consistent? Where am I making the most amount of money? And I pretty much stopped doing everything. And I wrote a notepad on my laptop every day with a sticky note that said, do not long a stock. And I'd place it there every day. That's what I had to do, because it was so enticing. I wanted to. I'm in the chat rooms. I'm seeing people talk about breakouts or first screen days or whatever they're called. And it's enticing to want to make money where other people are making money. But then I realized this isn't a game of us. This is a game of me. And where do I make money? Where do I prevail? And so that was the big turning moment in year 2.5, was identifying where my weaknesses and where my strengths were and putting all my focus into my strengths.
Oh, wow. And then you even though you said it took you longer, 2.5 years, I think most people struggle for, I struggle for 2.5 years. I think there's a lot of fast learners nowadays. Like I see some people who can do it in like 6 months or a year. Mm-hmm. But I would say 2 or 3 years is actually, I think, the norm for most people. So I don't want to discourage people if they take like a little bit longer, I guess.
Well, and the average, I think, is 2.5 to 3 years. And, you kind of relate it to other professions in the world. If you want to be a doctor, you want to be a lawyer, it's kind of the same pay structure to some degree. You can make upwards of that type of money in your earlier years, as if you are a lawyer or a doctor. It's possible. Yeah. And so how long does it take to become a lawyer? How long does it take to become a doctor? How long does it take to get into the NFL? These high-paying professions where when you're talking about consistency after 2.5, 3 years, you still have a long time in front of you to continue to work at it and reach heights that you never thought were imaginable. So it's not that long of a time. It's really not. But in the moment, it's a grind. It's not. It's not. It's a marathon. It's not a sprint.
Yeah, and you mentioned that you tracked all your trades, and that's how you figured out that you were better at short selling. What specifically were you tracking? Were you using, what kind of tools were you using? Were you using a spreadsheet, or what's on that specific spreadsheet? Like, just so our viewers, let's say some beginner traders watching this, they can kind of learn to identify where the strengths are and do what you did and focus on just those areas.
Absolutely. So there's a number of websites that exist now that allow you to track your trades. I mean, we're talking TraderView, Kinfo. I'm sure there's a number of other them that I don't currently use, but those are great resources for any newer trader. I think some of them are free.
Okay.
So you can just get bare bones data on your trades. For me, the one thing that I tracked in the beginning, I'm not the most detail-oriented person. I'm not tech savvy. I barely know how to use Excel, especially back then. I'm a little bit better now. It became more important in my trading as time went on. But in the beginning, I just pretty much had a calendar on Excel.
Okay.
And I would say, what was the ticker that I traded and what was the setup? And every day I would update that. And every month I would review that sheet and say, okay, where did the losses live? Where are the really bad mistakes living? And where's the consistency? And that's pretty much from that one sheet, I was able to just identify, okay, the longs are where I'm losing and I'm not controlling my risk. It's where that the R gets away from me. If I'm trying to lose $10 and I'm losing $100 instead, and it, for whatever reason, was all along, I always just wanted to fight them. I always just wanted to keep buying it, even though if it kept going lower. So that's what I learned. It was really just about taking out the things that weren't working with me and just being able to review that calendar sheet every month and stare at it until I figured out the missing puzzle piece or the puzzle piece that shouldn't have been there.
Okay. So you kind of started, if I'm doing the math correctly, you kind of started focusing on short selling around 2018, 2019. Yeah. So you were focused on short selling. And, what was the grind like? Because I'm sure, even after you found specific pattern or, area to focus on, there's still more work to do, right? Leading up into 2020, what was the work like? And how would you recommend viewers watching this, let's say they are in a similar stage you were back in 2019, what should they focus on once they find that specific strategy?
So this part of my trading career was really awesome because things actually got kind of easier in this moment once I started to take out all the distractions. I always tell people the stock market is like a candy store, and if you eat every single piece of candy in the candy store, you're going to get a stomach ache. But if you find that one piece of candy and you eat it moderately, you might not get sick. Okay.
Okay.
So once I found the one thing that if it was there, I would trade it, and if it wasn't there, I wasn't going to have a plate full of food. I didn't trade that day. If the opportunity wasn't there, I'd walk away. And just because there's no opportunity for me doesn't mean there's zero opportunity, just not for me.
Yeah.
So a lot of that for me in 18, 19, and 20, or 18 and 19 specifically, was this transition towards just specifically looking at OTC listed stocks.
Okay.
For me, it was buying listed and even shorting, NASDAQ or New York Stock Exchange stocks, and reading the tape was really tough in the beginning because things move so fast. For the OTCs, it seemed a little bit more slowed down. The level 2 was a little bit more easy to read. Time and sales were a little bit more easy to read. And the manner in which I got in, the indications of when to enter and when to exit were just easier to read. So everything just slowed down for me. And that was really important because then from there I could grow almost like having training wheels. And unfortunately, the OTC market does not exist anymore as much.
Yeah.
It's a completely illiquid market. I don't trade it at all anymore. I've had to adapt from that and move on to other strategies, which, sad to say, and maybe it comes back one day. And so it's always a part of my arsenal. But the main thing that went into focusing on one strategy was I had a DVD called Trading Tickers by a guy named Tim Grittani.
Oh, yeah. Okay.
And this is like my Bible. This is my textbook. Without this DVD, I don't think I'd be here today talking to you. It's a little outdated. It's back from 2015, but he had a number of short selling patterns that I started to try to mimic. Exactly what he talked about in his DVD. I just wanted to copy everything he did in terms of what am I looking for, how do I enter, and what to expect in terms of the data. And from there, my nightly routine or my preparation for the market open was to rewatch that DVD. I probably watched it like 5,000 times. And I'm not exaggerating. The reason I say that is because every time that I had this OTC short setup come up, I would rewatch the game footage from the night before. So I started to record my trades just like this DVD did. And so, when I had to set up the next day, I would rewatch the game footage on how I did it the last time and make sure that it was very familiar in my mind so that the next day it was a rinse, wash, repeat process. I wasn't really changing. I wasn't trying to be cute with it. It was just, okay, what are the bare bones general approach to this? And then execute that the next day and just keep it as fresh in my mind as I can.
And you were saying these were Tim Grittani's setup that you learned.
Yes.
Was there, I'm sure a lot of people, while they can learn from courses or DVDs, eventually once you find success or what made you become successful, it's not really copying it exactly, right? Did you tweak it at any point to fit your personality, or was it something like, you learned straight from him and you copied exactly, and that's what led you to the success you had?
Yeah, it's the latter. I
wow.
pretty much copied I'm not the kind of person at that time in my career. It's changed since, but at that time in my career, I wasn't trying to reinvent the wheel. I wasn't smart enough. I didn't know enough. Any kind of tweak to the textbook would make the equation incorrect. So I tried to copy it verbatim. And that's what actually led to my success.
Oh, wow.
Yeah.
Yeah. But you mentioned OTC market kind of died out.
Yes.
Was it, I think it was 2020. After 2020, it basically disappeared, right? So how was the transition from OTC to listed NASDAQ stocks?
Tough. The same rules do not apply across both exchanges, and the players are different, and the price action is different. The expectations are different. The time that I have to be involved in the stock, everything is different. To the point where I struggled after the OTCs went away in 2022 and 2023. Those were tough years for me. Barely even profitable, right? Which is crazy to think because I had a 5 or 6 year spree of profitable every year, making good money, making exceptional money, and then all of a sudden it hit a brick wall. And for a moment I was nervous. I was like, am I going to ever find it again? Am I going to be able to get it back? And I kind of had to, in order to adapt, I had to readdress the whole market from a different perspective. And I went into more of a data-driven approach than a discretionary approach, which was my discretion was I learned a DVD and I would discretionarily trade the things that I saw. And instead I said, okay, well, now I can no longer do that as easily. So I need to put some data behind my trades. I have to have some kind of confidence that these are going to work out the way that they're going to work out. And the place that I focus on now is not the same place I focused in 2020 and 2021. I mean, a lot of what I did, and maybe this is too technical for terminology, but I've shorted a lot of things called first red days.
Okay, yeah.
So stock goes on a big run and has this big pullback day, and I'd kind of be there for that. And whether it was a listed stock or an OTC stock, that was my job. I had to be there for that pullback day. Now I don't even look for that day.
Okay.
And it still exists. It's still there. People still trade it. But that's not my focus because I couldn't apply data to it. I couldn't apply structure to that kind of trade. And a lot of the times the losses would get away from me when I'd get too aggressive on that type of setup.
I see.
So my adaptation was going into the data, saying, how do stocks, we talked about gapping craps, right? Stocks that gap up huge.
Yeah.
I asked, pretty much a data sheet, and the website I used is called Spike Eat.
Okay. Yeah.
That's how I pulled all the data. It's another useful tool for someone that wants to get into it. And what I did is I said, okay, simple questions. If a stock gaps up 100%, right? What are the odds? What are the odds it closes below the open? How high do they generally spike? What is the average? If I shorted the open, covered the close, what would happen over the long run? And I'd create equity curves, and I would create just models of what trading would look like had I implemented certain strategies around these things that gap up and have a tendency to fade. And from there, that's how I built a whole new strategy that's where I focus.
Oh, and the reason you're saying the first red day you're no longer using is because you couldn't find enough data from the backtesting tool that support that particular strategy.
Yeah.
Is that correct?
And so I couldn't get size behind the ideas.
I see.
I really struggled with the approach of sizing into those plays. I I didn't trust the risk levels. I find that there's so many times that there's fake outs. And I'm one that doesn't want to fight a stock. I'm one that doesn't want to re-enter. I don't want to sit there and watch every tick of a stock all day. The whole thing, I did it for 6 or 7 years, and it really kind of drained me. And it made good money, and I'm not upset about that. But, how long did I want to, short a morning push and cover a pull? I kind of just got sick of it, and it wasn't making enough money for me to want to keep doing it. So I just shifted my focus to another area of small cap, which are the gappers.
You mentioned you were shorting the push and like covering into like the pullback. Is that kind of like scalping strategies almost?
It is a bit of a scalp, I would say. The percent gains weren't like 1%, 2%, or 3%. I generally went for 15 to 30% pullbacks.
Okay. That's significant actually.
For
small caps.
I call it because generally it's not just like there's a daily chart involved, right? And so a lot of the times, like I can see the range on the daily chart, I can see the extension, maybe I understand the story and the thesis, and I think there's room for not just a 5% pullback, but let's say the stock is up from $1 to 10. I think you can go back down to 8, and there's your 20%, but you're still up, 700% from the dollar. So in terms of the range of the stock, it's a small pullback, but in terms of a percent gain, it's quite nice. So that's generally what I look for in those types of plays.
So you went back to look at data, back testing in 2022. And now in 2024, what has changed? Are you still trading the same way? Or how have you kind of adapted to this year's market?
So 2023 was all about building that strategy. And 2024 was all about implementation. I sized down all my accounts. I said, hey, I don't know where this is going to lead. On paper, it looks profitable. Looks like it's a strong equity curve. It's robust. But anything can happen. And you can come in on a data-driven strategy at the very wrong moment, and it could just perform really horribly.
Yeah, it can be like one anomaly.
Well, it's not even just the one anomaly. It could just be an anomaly moment. We could have a bad cycle for them where maybe we just enter this extreme bull cycle and nothing is crapping anymore because there's too much demand, which was 2020 and 2020.
Yeah.
There's probably still a lot of evidence that they crapped then too. So 2024 was implementation of this new strategy. And the hardest part for me was ignoring my old plays, ignoring first red days, ignoring the occasional breakout or first green day. I said, I don't really want to, I can't focus there. I can't be discretionary and systematic at the same time. For me, it's one or the other because they're two different parts of your brains that kind of activate. So the biggest struggle I had this year is when you see to give you an example of a recent stock, Donald J. Trump's ticker, DJT, just went on a phenomenal run into the election. And you have another scenario where there's a first red day coming. There's probably a sell the news coming because we're running up into the election and it's anyone's ball game at this point, and you're probably going to get a pullback. And, a lot of people that I knew were watching for it, and even I was watching for it. But at the same time, I had to tell myself, that's not my business objective right now. It used to be my business objective. Now my objective is doing something completely different. And this different thing makes me enough money where I don't really need all of the candy to go back to that first reference. And that's been hard.
That takes extreme discipline.
Well,
do that, yeah.
Yeah, the first 4 months were much more difficult. Now we're towards the end of the year.
Yeah.
And now it's second nature. I don't even look at them. And it blows my mind because there was a time in my life that I would not ever leave the safe place of first red day type stuff.
So I like how earlier you mentioned that you kind of treated your plans with strategies as business plans.
Yeah.
I think more traders should think of trading as a proper business that way, in which you are hired by your business to execute the business plan, and anything outside of that plan, you shouldn't even touch.
Yeah, because if you had a boss, they'd fire you. They'd say, hey,
that's true.
That wasn't your role. That's not your job. Your job was to do this one thing, and now you've done 3 other things that weren't the one thing, and you've cost the business money, and unnecessary money, right? I don't care about losing.
Yeah.
I've taken thousands and thousands and thousands of losses in my career. What I care about is losing unnecessarily or undisciplined losses.
Yeah.
Those are the ones that I end up staring at the wall, kind of rethinking, or just staring into a space, just really upset with myself because I know better, and that still happens. I'm human. But yeah.
So you mentioned that this year you downsized, right? At which point would you start to size in again into this one strategy that you're focusing on?
It's a good question. I have a completely different betting strategy with it. So again, like the whole name of the game has changed for me in year 9, and it's been a very great year for it. Where now my betting is based off, again, it's more systematic. So my betting is based off my account size. So the more the account grows, the bigger my size gets. And vice versa, if it starts to deplete, my betting size also starts to deplete with the account. And mathematically, given the strategy that I implore over a 10-year period, it should be an uptrend. Should be. But that's how so the goal is to pretty much grow a 40K account, let's just call that, into like 200,000 or 300,000 or 400,000. And then from there, again, all of my betting size is based off my account size. So if my account is closer to 200K, my risk is going to be closer to 15,000. If I get up to 400K, it's going to be closer to 30,000. And hopefully, since all of the trades in this account, it's one account, one strategy, no other trades can be made on this account. It's just, this is this business. I want to see how it grows. It's a systematic approach to allowing the betting size and the risk to grow as the strategy performs well.
Oh, so essentially your R is whatever your account size times whatever percent that you're risking each day. So every day you're kind of, depending on how the previous day goes, you're taking either bigger size or less size.
Exactly.
Oh, that makes sense. I think that also means if you are in a period of drawdown, you take a lot less size going forward, right?
Right. Yeah, as the account diminishes, I get less and less and less buying power. So the gains become smaller and smaller and smaller. And it's kind of this grind to get back to where I was. And that happens. There's cycles. I mean, there was a month at one point where the strategy was completely broken.
This year?
Yeah, but it didn't blow up. It just was very sideways, if anything, just like a small downtrend. It's a very frustrating moment to continue with it, to stick with it. But then we came out of that, and here we are.
Was that in September of this year? Is because I remember September was kind of slow for small caps, right?
I want to say...
Was it August or September?
I don't remember.
Oh,
I want to say that. I don't remember which month it was. I think there's been a couple months. I think it struggled a lot in April. I think April was really tough for it. And I can't say if it was like if it was like a slower small cap area or just things were getting a little bit more squeezy in that time, for lack of a better word.
Okay, yeah.
You know, things would open and they just run 300% off the opening print, and like that's going to stop me out every single time, and I'm going to take a rip.
I see.
I have a stop loss in at all times. And I know exactly how much I'm going to lose at the start of my day. And every day I update the bankroll so that it's very mathematically proportioned. Yeah. And, there's some months where it's just really slow and I'm just taking loss after loss after loss. But I've stuck with it. I've stayed consistent. I've stayed disciplined. In April, although I think it drew down like 20 or 30K, we've gone much higher since then, fast forward to the end of the year.
Yeah. So let's talk about this new strategy that you kind of honed in on this year. If you could describe to our viewers at a high level, like what's the general thesis and what kind of stocks are you looking at?
So that kind of takes us back to the original how we started this interview, which is the bloodline of small cap, right? Okay. Like that's the high level, big picture. Like how are these companies getting money? It's because they have dilution. They have excess shares to dump onto retail. And what are they doing with these PRs? They're fluff PRs. They're a lot of the time fibbing numbers or embellishing stories or repeating stories that they've said in the past. And it doesn't matter which variation of it. The mass majority of these, $10 to $5 stocks are doing some kind of variation of this just to stay alive. They can't get their money from the bank, so they have to finance their stock. That creates this infinitesimal edge for me that I think there's always going to be this heavy selling pressure on these stocks that have a habit to fail, that have a habit to be sold into. Okay. So that's the high level as to why it works. And then the data behind it was just very simply asking, again, what I said earlier, which is like, okay, if I look at all of the stocks since 2008, so to speak, that have closed at 1 and gapped up to 2, so 100% gap up, not just 1 to 2, but 100% gap up overnight.
Okay.
How do they act? How do they perform? do they close below the open or do they close above the open? And what I found in the data, which was kind of my leading variable that I really attached onto, is that I saw that in the data, 60 to 70% of them will close below their opening price. Now, that doesn't mean they won't spike first. So we gotta understand that these things are volatile. They're cheap stocks, they're crappy stocks, they're gonna move because there's a mixture of longs and shorts battling for the right price, and they're extremely volatile. But we ignore all of these games that are being played in the first hour and a half. What is the end of day result? What is the expected value at the end of the day? What do I expect? And I expect right now that 60 to 70% of them will close below their opening price. And why? Because a lot of them are dilutive piece of crap companies that need to stay alive. So once I had that part of the equation, it was all about, okay, now where do I find good risk reward? How do I position myself so that by the end of the day, I'm here and I haven't gotten stopped out? And that's where the sauce is, I think.
Yeah, that's a tough part because you cannot just short every little spike on the way up and blow up, and then
because some will absolutely blow you up.
Yeah.
I even did a back test that said, what if I don't have stop losses?
Oh, okay.
And the crazy thing is, it wasn't as bad as I would have thought. It's not profitable because there's a couple black swans that are going to come and they're going to go from 1 to 40 in a day. And if you're short from 2, you're going to lose your whole account, right? And that will happen. So it's not a profitable thing to do, but in the back test, a lot of these do come back down, even if they spike to 40 first. They don't really hold their highs. Where is the stock least likely to go? How do I find a way to get into most of these and not miss them? And how do I be like risk reward affluent to some extent where it's a profitable strategy? And that was the hard part to figure out. That's where, okay, I can give you framework, which is how we started, gave you the framework behind it. But as far as actually entering the stock and implementing strategy, that's where you got to take a different part of your brain out and say, okay, what in the price action do I need to see? Do I want it to spike at first? I want it to break lows. I want it to be below the volume weighted average price. Where do I want the stock to be if I want to enter? And that's where success is found, finding that entry.
Yeah, it sounds like you are shorting first, I guess, day one runners, the ones that say with like really a lot of dilution, a lot of repeated news or like fluff news, and then you are short. But are you swinging those overnight or just close them first day?
So if there's a stock gapping up 100%, just to be frank, if it's gapping up 100%, there's like an 80% chance I'm shorting it that day. Like Mike Huddie is getting short at some point, I promise you. Now, the only caveat is if it's under a 1 mil float, there's a chance I avoid it. Okay, that's the 20% that I don't necessarily short. Yeah. But everything else, I'm pretty much shorting as long as it's a small cap underneath 300 mil market cap. For the most part, this whole year, I have covered as close as I can to the end of the day. I want to give the stock as much time to fade and prove to everyone that it's the piece of, crumb that it is. So I try to give it as much time to fade as much as possible. Some of these are very extended. And what I've realized after this whole year of doing this is that a majority of them gap down the next day, and that there's actually even more on the table. Like, there's just more on the table. So the question I have for myself is it worth it to swing? The data says yes, but I don't think it picks up on black swan events. So the data says, maybe I'm just going to give out a number for example's sake, educational purposes only. Let's just say the data says that you make an extra 5% if you swing overnight. Okay, great. That's added edge.
Yeah.
But what if it goes to 200 overnight and then next day doesn't offer and it opens up way lower later? That's what the data cannot pick up on. The after hours and pre-market action that can get weird. Are situations that can blow you up. A stop loss might not work in the after hours. I mean, there's a number of things that can happen that it seems like swinging overnight opens the door up to this risk that is unquantifiable and not necessary to be opened up to. Now, with all that being said, I have started swinging them overnight.
Oh, okay.
Again, restarted an account. This is the swing account. And now for this past 2 months, I've been swinging them overnight. I have a stop loss in as soon as the market closes. I have a stop loss in as soon as the market opens in the pre-market. I wake up at the brink of open and I put the stop loss in. It has to be in there. There's no questions about it. We just saw a stock the other day go from like 3 to 120 in the pre-market. It was TNON.
Oh, okay.
And so I saw that, and again, like unquantifiable risks. And I would pray that a stop loss would work there, but if it doesn't, it's a big risk to the overall strategy. So
Yeah.
I am playing with it. I have float restrictions in terms of what I am allowed to swing and what I'm not allowed to swing. And again, I restarted the account so that if that account blows up, it's not going to affect my bottom line.
Yeah. That's like the test account. I
Yeah,
guess.
exactly. I'm
Yeah.
testing with it, and I'm seeing how it
Okay.
feels, if I enjoy it, if I want to set the stops, if it really makes that much of a difference. But I find that a lot of the ones that like maybe I'm covering towards close, if I had just swung them, it'd be a much more profitable situation. And I kind of want to be there for that. So the data supports it. I'm enjoying it so far. It's also terrifying to swing overnight short.
I like that even though you're pretty experienced after 9 years of trading, you're still experimenting and kind of pushing through areas that you're not that comfortable in. I think that's good.
Yeah,
I think
I mean,
all traders need to do that at some point.
Absolutely. There's so much
Yeah.
growth that you can have in the markets, whether it's from taking day trading and going to investing, taking day trading and flipping between different patterns when necessary. That's all. I even did some options and puts trades in these past 2 years, which I've never done. And I could probably count on both hands how many times I've ever taken an option trade in 9 years of trading, but I still want to push myself into that realm, and so I know more about, puts and calls.
Yeah. Yeah. Going back to the strategy execution, it sounds like you keep it very simple, right? You don't do the add on the way up. So do you just go one entry in short and then one entry at the end of the day to cover?
Correct.
Oh.
One shot, one kill. That answers your question. It is one and one.
Yeah.
But I have two ways to approach. I have two strategies within one, not to be too confusing.
Okay.
But I have pretty much an around the open strategy on how to enter. Okay. And then I have more of like a breakdown entry later on in the day that I also enter on. And so in theory, the open strategy can fail, and the breakdown entry can still succeed. Yeah. So I give myself two shots, but they're completely two different methods of getting in, two different entry signals. Sometimes they both work. Sometimes they both fail. Sometimes one works and one doesn't. Yeah. They're still separate strategies, so it's like still one shot, and then one cover towards the end of the day. And that's how I trade.
So if you get stopped out on the first entry, do you still would enter, like the second entry shows up later on, you would still get in?
100%.
Okay.
I do not have a choice because, again, like I want to emulate the data. I want to emulate the equity curve that I built, the model.
Yeah.
So I can't say, I lost, let's call it a number, $2,000, $3,000 on the first entry, and I don't want to lose another $2,000 or $3,000. Like I have to. And if I avoid it and it ends up working and I would have made all my money back, like it's not okay to miss that. It's the business has now failed. So it's not great. I always kind of reluctantly sometimes when, sometimes I take a loss on one entry and there's slippage and there's locate fees and maybe it's reg show and I have to reborrow the share. So there are these decisions you have to make before taking your second entry, which I reluctantly sometimes, I'm like, I don't like the float, I don't like the volume, I have all these thoughts, but I force myself in because, again, it's my business to force myself in. I have to. I can't shy away. The other stuff I can kind of leave alone, the first red days and stuff.
If everything goes well according to the system, what's the expected win rate of this particular strategy?
I would say it's somewhere in the ballpark of, and again, it's just sometimes the paper and the actuality are not the same. But I would say there's like roughly a 65 to 70% win rate on it.
Okay. Yeah.
That's what I generally hit, and a couple of my buddies are trading it as well, and they're hitting that range as well.
Okay. And like the risk reward, what should one expect?
The risk reward is not great. So
okay.
I found the key to gapping craps is a wide risk mentality. I found that when I used to try to trade them as a beginner trader, I would always want to risk high of day. Stock sets a high, maybe has a hard pullback, and maybe on the next rebound, I want to get in and size into high a day and have some really tight, good-looking risk. And the reward can be, exponentially bigger. But I found that every time I did that, I'd get stopped out. it would make a new high and then it would pull back and I'd want to get back in and then it would make a new high and it would do the same thing. And I get stuck in this manipulation area where they're trying to stop you out, hunt for liquidity, whatever it is. So I went with a different approach and I said, okay, well, on average, what do these things spike to? On average, where do they not go? And so I actually go in with this wide risk approach that says, okay, I'm going to get in and I'm not going to risk a part in the chart that anyone else is risking. I'm risking, 90% of traders lose. I don't want to be risking high of day if 90% of traders are risking high of day.
Yeah.
I want to risk the area where the stock is least likely to go. And so that means that I have generally smaller size because I have wider risk. So it's a bigger percent loss. So I don't get as much equity in the stock as I normally used to back in my career. And since I have wide risk, the risk reward ratio is generally like 1 to 1.25.
Okay.
So it's barely 1 to 1. It's barely over 1 to 1. Nothing phenomenal. And that's, over the aggregate of all of them. Some are better than others. Some are way worse. Generally, that's what I bet. So I've found ways to improve that equation. That gets a lot more complicated in terms of like, when do I want to size into high a day? When do I want to build risk into high a day? Sometimes the strategy does call for that. But the bare bones strategy is more of a wide risk mentality approach. And it's a 1 to 1.2 risk reward equation. But all that mattered to me was that it was profitable, that there was consistency and that it would make money. And so once it proved that and the equity curve was, again, just super robust, I trusted it.
Yeah, it kind of makes sense that, okay, now that you explained everything, it makes sense that you are choosing the day one gappers because they gapped out 100%. That means they're 100% downside for it to go. Okay, so I can see, even though the risk is wide, the downside is also a lot more lucrative as well.
So downside is generally what? It would be like 50%, right?
Yeah.
Because 150.
Retracement, 50%, yeah.
So that's where the 1 to 1 comes in, right? Because sometimes my risk is super wide where 50 might be what I'm risking.
Yeah.
In some cases, I am. In some cases, these go, they start here and they gap up 100% and then they go lower than where they came from. I've seen stocks go down 70% in a day. So there are situations that are just even worse than they appear, right, behind the scenes. But yeah, so there's a lot of downside in a lot of these. And so with a higher win rate and some of these that do really fail and fade well and in certain market environments, it performs a lot better. You can make a good killing.
You touched up on borrow fees and reg show earlier. With short selling being so popular nowadays, and locate fees, sometimes they can be really cheap, but a lot of times on the day one gappers, the locate fees are insane. I've seen like 50 cents, $1 per share. Do you ever worry that the fees are getting so extremely high that kind of erases a lot of your reward?
Yeah.
Or what are some ways you're managing your short selling strategy? So despite the fees or or maybe you found some place where you can save some fees, how are you managing that?
I don't think I actively manage it. I think that the locates generally are less than 3% of the current stock price.
Okay.
So that's kind of like a majority are less than 3%. And 3% is not enough to erode the edge.
Okay.
I think when you get towards 8%, so a $5 stock with 50-cent locates, I'm probably not taking that.
Yeah.
I'm probably just saying, okay, this one's bad for business. Like, again, like the data cannot pick up on the locate fees.
Yeah, no.
So I can't factor that into the equity curve. But if you have 50 cents of locates and $2 of risk, let's just call it, it's very hard to find a profitable equation within there. So some of them I just don't take if the locate fees are too expensive, but it's very rare that I see that. And they're generally on the low floats, which
like micro
which I tend to avoid.
Yeah.
Because that's all baked in, right? I've tried to do the low floats and I just found too often that, number one, the locates were too expensive and I'd avoid the trade. Or number two, the action was too wild that I would I'd make a mistake while in the trade. I'd get scared.
Yeah.
And I'd click a button when I'm not supposed to click a button. So that's why I try to avoid those sub 1 mil floats, because mathematically that's where you're going to find your higher locate costs. And so that's probably how I manage it.
Yeah. And it does seem like nowadays everyone wants to learn short selling. Do you ever worry or think about whether that just means every couple of years you have to change or adapt your short selling strategy? Because it's kind of getting crowded sometimes.
It is crowded.
Yeah.
And I think it's more crowded on the first red days, which is why I'm no longer there. I'm taking an approach that I think most aren't willing to do. Most aren't willing to be disciplined. Most aren't willing to have wide risk. Most aren't willing to go through the grind and have this like systematic approach. They want the action. They don't want certainty. They want variability. For whatever reason, it's a human emotion. We're not all rational. So I actually don't think that most people are willing to do the things that I have to do in order to win. So that's number one. And I've tried teaching people the strategy, and they try it for a couple of days and they hate it. Good.
It's too much sitting there waiting.
Or for me, I leave. I don't even watch, right? I don't need to wait. But for them, it is sitting there and waiting. And then they're watching the chat rooms, and they're watching everyone else trade. And someone made 20K over there, and now they want to go trade that, and they're bored of this. It's not making any money. So it's really hard for me to think that my strategy is ever going to lose its edge for that reason. I don't think most people can do it. It's hard to be disciplined to one strategy. And then further, I think what will always remain is the dynamic that is the higher level understanding of what are these companies and why are they gapping in the first place, which is dilution, bloodline to survivability, make money through selling paper onto retail. And I don't think that's ever going away. So I don't think people are willing to do the setup the way that I've designed it to be. And I don't think that small cap will ever not be diluting. So for those two reasons, I don't think my strategy will erode. And if it does, I'll tell you.
Actually, that's true, because now that they're cutting interest rates slowly cutting more rates, that means it's easier for those small caps to borrow money and do financing. So if anything, they'll probably do even more dilution.
Great.
Yeah.
Great for me.
If you think about it, that's what happened during COVID in 2021, right?
Yeah.
Yeah.
So that dynamic is always going to be there. And so that's kind of, again, what I think is the biggest edge. That's the high level looking in. And then strategy specifics are, I think, hard to emulate.
I see. And you mentioned that you don't even look at your trade or your orders once you placed it. How are you placing your orders and executions now? And how are you walking away?
Yeah. And again, this is the part that I think is, again, just really hard to emulate. It's really hard to not watch. It's really hard to... I've been taught my whole life, from many gurus that are very prominent in the industry that like price action is king and volume is super important and stuff moves and wicks and shooting star candles. I'm just naming a bunch of technical analysis, VWAP. Yeah. Just naming a bunch of technical analysis indicators. My strategy uses none of that. I don't need any of that to do what I do right now. And again, it's hard for people to wrap their heads around that. But I think that most of the price action that we see is built to bamboozle us, to think that it's bullish and they're going to rug pull, or think that it's bearish and they're going to spike it. So a lot of what we're reading, someone thinks like a stock kind of makes like a downward move and then an L. They're like, oh, it's building a base. It's going to come back. Okay. I actually don't subscribe to that. I don't think that's true. I think they're building a base to make you think that. So you kind of buy it out of the base and it rug pulls. At least in small cap. A lot of times in small cap, you're going to see just games on games and games of manipulation because, again, what's their goal? Dilute. So how do we get people to buy so we can sell? So how do I enter and how do I exit? That's a harder question for me to answer.
Okay. But you're saying you just place the entry and the stop and you just leave it be.
Yeah, I don't want to give like the exact specifics away, which is why it's hard for me to answer.
Sure.
But exactly. So I know that in the first hour and a half, I'm going to have my entry. Okay. And in the first hour and a half, I'm going to have my risk level. That is for sure. So it usually takes me within the first hour and a half, I will absolutely have at least one position. And right when I take the position, a stop gets placed at much higher than where it is. And then at that moment, I can walk away. Once the stop is in and my entry is in, I can now walk away because I don't want to cover until as close as I can till end of day. That part I don't mind discussing. I think the best covers are usually end of day. Again, another very hard thing for people to do because if a stock drops 30% from your entry, you're going to want to cover. Yeah. But my whole thesis is the end of the day cover is even better. And that's sometimes not the case, right? We're talking about averages. But it's a thing that people aren't willing to do is wait till end of the day. It's hard for me to wait till end of day. So I leave. I don't want to watch because for me, it's binary. Either I get stopped out or I don't. And if I'm not stopped out, then I have to hit the cover button at the end of the day. If I am stopped out, then there's no stock to cover at the end of the day, so to speak, right? So yeah, I'm entering in the first hour and a half. I set a stop, much wider than where I'm entering, and then I'm looking to cover at the end of the day. The one thing I'll do probably from my phone is about midday to control the risk a little bit. This is more risk management. I move my stop to high a day once most of the morning action has gone. So we're talking like 11 a.m., noon. What is that, Eastern? That's 3 hours in? Yeah. That's when I place my stops to high a day.
Okay.
So it really lowers the risk. I can have a situation where it's a super small loss and a much bigger gain. And that's really the only thing I do. So.
And it's a live market order stop.
Yeah.
Oh, so you're not worried about getting stop hunted and stock takes out your stop and then comes back down. Like that's what people say. Oh, I don't want to leave live market order stops because of market makers taking out my stop. What's your response to that?
That's BS. I don't believe it's true. And if it is true, I don't believe it. I think that your stops get taken if they are in an obvious spot to be taken. If they are clearly at this big breakout level, or if it's at this like key level, like they know, and they're going to go hunt that area. I'm putting my stops in a place where they don't know where I am.
Okay.
And then eventually I kind of do move it, but I move it at a time where it's harder for them to reach me. Maybe the stock has faded, 30 or 40%. So it takes a lot of money to bring that stock back up. Sometimes it happens, but most of the time, by the time I'm placing my stop where everyone else is, the stock has really broken down and gotten really far away from there, where I think the actuality of being hunted is impossible. But I really don't believe in, and I used to. In my beginning days, first 2, 3, 4 years, I never used a stop, not once in my life. I didn't believe in them. I thought they hunted me. They always knew. It would touch my stop, and it would just bounce the other way. And I'd have that one arrow at the bottom or the top of the chart. And I really thought that they could see it. And now I realize the error was in my understanding of human psychology. We're all putting our stops in the same places. And so they know that and they go reach for them. And then we think, oh, poor me. But it's really an aggregate of people that just got stopped out. And they knew that. Yeah. So again, I try to keep my live stop order at a place where I think that they are going to have a hard time reaching me or even finding me in the first place. I'm not in the obvious spot.
Interesting. Yeah. That's and then you just come back at the end of the day, you cover and hopefully for a profit.
Yeah.
Oh, okay.
It's really fun.
How many trades, I guess, on average you take per week?
So I can tell you that I've probably taken this year maybe 150 trades of gappers that fit my criteria. This week I've taken, it's Tuesday, I've taken 4.
Okay.
Yeah.
Yeah. That's actually a lot less than what I was expecting.
Well, like this morning I woke up and there was 300% gappers. But sometimes I wake up and there's none.
Yeah.
So I go back to sleep. Because again, my opportunity's not there. So I don't have to watch the market anymore. I don't really care what's moving and everyone else is watching. I just care about the gappers. And some days that there's many, sometimes there's none, sometimes there's one. And it's really a calm and easy place to trade from. For me, at least. It's
probably less stressful and a lot less distractions.
There's a lot less indecision that goes into, oh, is this the right lower high? Oh, is this the right spot to enter? Is that the right risk level? Like all of that is already pre-mapped out and drawn for me. So trading from a place of certainty is like, I've never really had it my whole career. And you can make money trading in a place from uncertainty. That's where a lot of risk gets taken and you can make a lot of money in that moment. But I've kind of flipped it the other way now.
Yeah, I think that's a sign of a maturing trader.
Yeah.
After 9 years, you don't want the fireworks, the ups and downs, that kind of...
I was a kid, I lived for it. As a kid. I'm 30 now. And when I first started trading, you can imagine I was 20, 21, and I lived for the rush. I loved the rush. I loved being involved in anything and everything. And that's probably something we should shy away from because although it can be good, and if you have a passion and obsession, then you can go very far in this game, but you have to learn how to control that degen is really what it is inside of you that just loves the dopamines that you get and the endorphins that you get from being involved in a trade. And again, like that can push someone to be a very successful trader, but it also can be your demise.
Yeah.
And this game is about longevity. And so there's many ways to burn yourself out and just like not want to look at a single stock again for the rest of the year. And I'm trying to avoid that because I enjoy the game. I enjoy the puzzle.
Yeah, yeah. It seems like every couple of years you sit down, you like look at your data, and you find out what's wrong, what's there to fix.
Yeah.
That's as long as it's not too often, I guess. But
for me, it's like every 3 years, every 3 to 4 years, I've had to do this, and I didn't think that was going to be the case when I first started, but that's just the reality of it. That the markets shift, patterns shift, edges that were there aren't going to be there, frameworks will always be there, big picture analysis will always kind of be the same, but methodology is what changes, and players kind of change as well.
Yeah. And it also seems like you've kind of switched to this method of trading to fit your lifestyle, because you mentioned that you travel quite a bit. And that was originally the Tim Sykes lifestyle that inspired you. Could you tell us, our viewers, kind of how you structured your life nowadays so you can trade and travel and kind of still have a life outside of trading?
Yeah, so again, the first couple years of my trading career, I would trade like 6 to 8 hours a day, and I would watch after hours. I'd watch every single tick of every single stock. And I think that was good for the time that it was, but it was very hard to travel. There's a point where I always get this backwards, but it's like, don't trade to live, live to trade. Don't live to trade, trade to live.
Yes.
Okay? And at one point I was living to trade. And I think a lot of people get into trading to have this freedom and this great life, but then they end up just watching the screens all day, and they don't go outside. They're just trading, making money. And that's great, but for why? At some point. So it's harder when you're traveling and trading, and you're making watch lists, and you're planning all these trades of all these different patterns that are showing up, and these scenarios that are kind of boiling in the background or brewing into something bigger. You got to really stay on top of that stuff. So it's very hard to travel and trade, because for a number of reasons. Number one, if you are traveling and trading and you're with family or friends and you take a big loss, it has ripple effects for your demeanor, your mood.
Yeah.
What are you going to do the next day? Are you going to skip out on trading, or are you going to make the money back? Is the rest of the group going on jet skis, and now you're not going jet skiing because you have a trade you want to attack? So learning how to kind of manage all of that's really important. For me, it's really tough. So for me, it was really tough to manage all of that in the beginning. I think I did the first. So to kind of backtrack, I go to Europe every summer. I go for like 2 or 3 months.
Okay.
I found that trading is slower in the summer, and that's where I would have my least profitable months, again, from the data. So instead of trading, I wanted to spend my money on a boat, or spend my money in Europe, or be in Italy. It didn't matter. Like, there's no point for me to sit here for a month and make $5,000. I'd rather go spend $5,000, $10,000, 15, whatever it was. And I'd find that I'd bring my laptop and I would try to trade, and all that would happen is I'd get frustrated, and trading would be on my mind, and I couldn't really get away from it.
Yeah.
So what I ended up doing was, year 4 or 5, once I had some profitability and some success and a good year already under my belt, I would leave my laptop at home. And I wouldn't, and this was before like DAS Mobile existed and stuff like that. So there was no trading on my phone either.
Okay.
And I would just leave it all at home. I would say, hey, this is like how I take a break. This is how I decongest from the market. And then, when I get back, it's that August, September, October, November push, which is generally when small cap gets kind of hot again, especially into the winter months. So I really like that summer as like a way to break off and not be in the Discord rooms, not be watching every tick of every stock and building watch lists and scans. And that helped my mental a lot. And I got to enjoy myself. And so that's the first way I started to kind of interact with traveling and trading. And now fast forward to where we are now, my strategy, like I was saying earlier, only really consists of me being at the market for the first hour and a half. And then I just kind of have to be there towards the close to exit the positions. And this is like a really hands-off approach. Again, something that I never really thought I'd be doing, but it's not about watching every tick. It's not about watching every consolidation pattern or structure. It's just about getting entry on a high odds setup and then letting it work as best as it can. And so this is the best way for me to travel and trade. Now I don't have to leave my laptop at home. Now I can do this because the losses are quantified at the start of the day. The size is quantified. I know exactly how much I stand to lose, and I can deal with that number. Whereas if I'm trading more discretionary approach, you can end up wanting to lose $2,000 and end up down 20. You know, it happens, unfortunately. And if that happens on vacation, it's even worse because now the vacation is ruined a little bit.
Yes.
So this current way that I have of trading it really fits my traveling agenda, which, you know, I spend 2 months in Asia every year. I spend 2 months in Europe every year, and it's super hands-off approach, and it's been working for me so far.
Yeah. So I guess the European time zone, you'll be entering trades like afternoon, evening, and you cover at night.
Yeah. So 2 to, depending on which part of Europe,
Yeah.
2 to 4 o'clock is generally when I'm entering trades and covering 9 to 11 p.m. Generally at dinner.
Yeah.
Usually at dinner. And when I used to buy stocks, I remember being in Europe, I'd buy stocks at dinner. It was a lot of fun in 2020, 2021.
Oh, okay. But I guess it will be if you were trading in Southeast Asia, you enter at like local time 10 p.m. You have to wake up at 4 a.m. to cover. Oh, okay.
Have to.
I see. Yeah, yeah.
So that's my job description. Someone said, "Hey, here are the rules and engagements. You gotta be here for these 2 hours, and you gotta be there at the end. And I don't care what time it is. I don't care where you are in the world. I gotta be there."
Yeah. So is this travel trading lifestyle as good as you first saw it 9 years ago?
I think it's better.
Yeah.
I think it's better. I mean, I've traveled a lot of the world at this point, and there's so much to see. There's so many beautiful cultures and places and foods to eat and just views to embellish in and people that are great. And it provides so much perspective. For me, when I come back, it makes me more well-rounded, more understanding. I love every single thing about traveling, and usually when I'm on the road, I just want to stay on the road. I don't want to come back, but I have friends and family and significant others that I got to get back to. But if I could continue traveling, I would. Yeah.
So is that where you spend the majority of your money? And where do you spend your profits, or spend or invest? Or
it all goes to health, wealth, and travel.
Okay.
I told myself I don't care what the cost of the food. I want to be able to spend money on food. Generally, that's not like that doesn't necessarily mean like $1,000 steaks. That just means like I want to be able to go to the grocery store, buy whatever I want. I want to be able to go to dinners, have whatever I want, order whatever I want, and that's really important for me. And that becomes a big expense after a while because I like dinners a lot and stuff like that.
Yeah.
Traveling is definitely my biggest expense. It's close to 6 figures almost every year. And then those are the biggest expenses I have for sure.
Where do you invest your money elsewhere?
Yeah.
Or what kind of investments do you deviate towards?
So after I had my first really big year in 2020, the first thing I did was I bought a house.
Okay.
I got some really wise advice from a friend that said the biggest edge in terms of the economy right now is the interest rate. And if you can lock in something under 3%, you're going to be good. So I had my first, I think it was like $600K a year in 2020, and I immediately bought a house. So I have that, and it's a really great interest rate, and I made it a rental. I don't need a house. I'm generally always traveling.
Yeah, I was like, you don't live in it.
I haven't paid rent really in 2.5 years. So I bought a house, and I immediately turned into a rental, and that's a good investment property. It creates good revenue. It's appreciated nicely, and it's got a really nice interest rate, right? So a lot of my money is there. A lot of my money is in the overall stock market. I have made some investment choices under my own ability, but I've pretty much liquidated myself out of all of the good decisions I have made and then hired an investment advisor to take all of the money and just get me in and to build for a 10, 20, 30-year type future. Yeah. And I had a hard time kind of separating myself from all that money, but I understood that it being in my bank account is losing to inflation every year. It's just depreciating. I needed to get it into a different vehicle and ideally something that beats inflation. So those are the two main places that I am diversified between. It's the stock market and it's real estate. And then I have also been reading books. The ones that I really like are from Tony Robbins. He has 3 investor books, and he's kind of like not really an investor himself. But I read his books, and they talk about just different ways to learn about just different vehicles to put your money in.
Yeah.
So there's something called like a general partnership stake that I'm in that pays me like 12% a year on the money that I give them. And it's 0 to 1 correlation to the stock market, 0 to 1 correlation to real estate. And so I like to be diversified in that aspect. And that's right now where I have all my money between those three things.
Yeah, it's interesting. I've interviewed a lot of traders, and the number one common thing they say is that once they made their money, they want to make sure the money is out of their trading account. Like you don't want to keep all that money in, because I feel like we are the biggest risk
You
to
could lose
our
it.
capital.
Even if it's not in, you could still lose it. I've never been that big of a trader. I've had moments where I kind of take excessive size, but I've never really needed a $200,000, $300,000, $400,000 account to make good money. I think with a $50,000, $60,000, $70,000 account, you can make really good money and have some serious risk on the table that you could lose a lot too.
Yeah.
And so I always thought it was I've never been the guy that's like, oh, if I have $400,000, I have to make the $400,000 grow. It's more like, what can I do with $70,000 and
Take out the rest.
Yeah, and take out the rest and keep it low.
Yeah.
Because with a $70,000 position, you make 20%. It's $14K in a day. It's way more than enough for my lifestyle. In a day, and you spend that out over the year. And it can be a lot of money. It has been a lot of money for me in some moments. So yeah, I'm a big believer in keeping the account size small, keeping the ego small, right? Because you can get humbled really quickly.
What kind of tips do you have for, let's say, newer traders who are still kind of struggling with finding consistency? What do you have any tips for them that they can kind of start taking action and stop getting distracted by social media or people on Twitter, this and that? Like, what should people actually focus on?
Gosh, I used to be a big believer in Twitter, and I've deleted Twitter and Instagram off my phone because I think it's really toxic. I think so much of the information that I hear from other people, I don't agree with. And at one point, maybe I did agree with them, or at least I thought I did. But through my journey, I've actually debunked a lot of the things that I used to think are true. So I would say number one is like, be careful who you're listening to. I don't care how many followers they have. I don't care how much money they've made. I would be very, very careful about, what opinions I allow to influence what I am here to do, right? So that's number one. I would say stay off Twitter, but I do think that there are some valuable resources on Twitter. It's hard to say completely stay off of it, but I like Twitter more for networking than finding information that's going to help my trading, right? Most of Twitter is just going to make you envious and jealous of other people's trading, and then make you think that your trading's not enough, or that you're doing something wrong. Why were you short and he was long or short, whatever it was. So be careful of Twitter. That's number one. And I think that's not a tip that is most often given. The other two tips that are often given is track your trades, which is how we started this whole conversation. Understand your strengths and your weaknesses, and focus more on your strengths than your weakness, right? No one's ever going to make their weakness a strength, but you can strengthen your strong points. So find out what those are and focus. And then last and foremost is the only reason that I became super successful was because I found one pattern, I focused on one pattern, and I ignored what everyone else was doing. It really comes back to that Twitter conversation, which is just stay in your lane, know what your lane is, and stay focused, right? Don't get distracted. And I think those are three really good things to kind of, keep in the back of your mind as a perspective as you're going through this marathon of a journey.
Yeah, I do agree about the Twitter and social media in general. It's like nowadays there's not a lack of resources. It's just too much resources and information, right? Even though I've interviewed so many traders, I've never told our audience to follow any one particular. It's like, well, you find what you like and just stick with what you like and what's working. So yeah, I echo that comment about social media in general. I think it's very hard to find focus, even for someone as experienced as you are. That's why you have to delete social media platforms, and that's why you have to stick with just one strategy that works for you.
Yeah, it can be absolutely overwhelming, and then analysis paralysis, right? So that's a good tip.
At the current stage of your trading for this year and going into next year, what are some goals that you have for your trading performance, or just, business, trading, making money in general?
Well, that's a good question. This year was really goal oriented, and I don't know if next year is going to be as goal oriented, if that's really a word. So I go to Thailand usually from December 20th till January 20th. I did this last year. I'm doing this next year. And probably asking yourself, why am I telling you this? I don't just create a New Year's resolution. I go to Thailand. I focus on health, and I'm super sober, and there's no caffeine, there's no sugar, there's no alcohol, there's no distractions. It's all healthy foods and outside and working out and listening to books and getting massages, etc. But keeping my mind in a really sharp place. And then when I'm there, this is where I start to craft my goals, craft my intentions, listen to books, and start to get certain ideas on what I want to do for the year. So in 2024, my main goal was to get X amount of dollars. I wanted to read all 3 of Tony Robbins' books, which are behemoths. They're not small. Yeah. And there's 3 of them. And so I wanted to read all 3. And then I wanted to implement 2 of the strategies from all 3 books. That's what I wanted to do. And I also read like 4 other books, but this is the one I wanted to take action on. And then throughout this year, I was able to not only read the book, take the information, put it into action, get the money invested, and now I'm seeing return. So that's a big goal of mine, because now I'm taking it from cash and really investing it, not just in the real estate, but I'm also in other areas as well. And that feels like a good progression towards a 10-year goal. I also wanted to execute this strategy that I've been building all of 2023 and into 2024. And that came with its own trials and tribulations, but here we are today, and it's absolutely exceeded any kind of dollar amount that I thought I would end the year. I've doubled what I thought I would end, given what I thought was possible. So it's awesome. Yeah. Now, next year, I have to go to Thailand again in December. Through January, which I haven't done yet. So I don't really have all my goals crafted, but I do have a perfected vision of this strategy going from where it is right now to a compounded approach throughout the whole next year. And I want to see how big it can get. I don't want to ever downsize it. I want it to just grow, and see where it goes. And the expectation is I can make $1 million next year through this one strategy. And that would be pretty cool. If it can do that through this compounding approach, and what that takes is an immense amount of discipline. So that's probably my most focal goal in terms of trading. As far as that goes, I just want to travel a bunch and continue to work on myself, continue to try to be a better person to people that are around me. And I'll have more goals for you after January.
Cool. Yeah. Thank you so much for sharing, Huddie.
Yeah. My pleasure.
Where can people find you on social media?
Super easy. At Mike Huddie.
Okay.
That's my tag. IE at the end. And again, I don't really go on that much because
it's Twitter, right?
Yeah, I try to delete it. I try not to be on it, and Instagram. But that's where I am.
Okay. Sounds good. Thank you, Huddie.
Thank you, Shay.
Huddie's story of adapting and tracking data in various market conditions and optimizing his trading style is very inspiring. If you want to learn more about different styles of trading strategies and approach from other millionaire traders, then check out this playlist over here.